Good morning. It's Kevin Lowe, National Managed Asset Consultant here at ScotiaMcLeod for our monthly conference call with the Portfolio Advisory Group. Today we have Chief Investment Officer and Co-Head of the Global Portfolio Advisory Group, Shane Jones, to talk about the portfolios that we provide to you. Shane, welcome.
Thanks, Kevin.
Just one quick question for you to get things started, and that is, we've seen some turbulence in the markets over the past few weeks. Are what we're experiencing more of a market phenomenon, or is it more of an economic phenomenon?
I think it's more of an economic phenomenon. Really what is occurring here is we had a great start to the year. Economic numbers look pretty good, across North America. Some of that came in Europe as well. We saw some decent numbers in Europe. Decent from where they have been over the last year or so. So you have to put that into context. And there were some signs that we were going to see a little bit of improvement in China. As March numbers have started to come out in the early part of April, we've certainly seen a slowdown in the U.S. Some of the numbers that have come out there, such as low retail sales, the jobless numbers, or the job numbers only gaining 88,000 in the month of March. Jobless claims took an uptick at one point there, but they've come back down in line right now with where we would have expected. China's GDP number, weaker than expected, I would say. Although, when you look back at the monthly numbers, I don't think that was a big surprise. Where the surprise came in for me was the industrial production numbers, which were quite weak. When you look at that and then you add on to that what was going on in Cyprus and the actions that the European Central Bank took in Cyprus, I think that sort of got a lot of people very, very nervous, is what I would say, with respect to the banking system as a whole, and could the likes of Cyprus happen elsewhere? And so, this economic uncertainty combined with the Cyprus issue has certainly, filtered into the possibility here that clients have now become somewhat fearful of what's going on in the markets, and I think there's some caution out there at the present time. We had been looking for a correction. We've talked about that through the month of March and into the month of April. This correction is occurring a bit deeper in Canada because of commodities than what we would have expected. We wouldn't have expected this deep of a correction in commodities, but more of a correction in the market. And an inline correction in the U.S. market is what I would say is where we're at right now with the expectations we had. The one concerning thing is the correction has occurred in a different fashion to what we would have expected, and much sharper than we would have expected. And when you see sharp moves like we have seen over the latter part of last week and the first 3 days of this week, it really brings back 2008 memories. And that's the big concern. And I understand people's psyche, and it is getting to people's psyche. When you start to see volatile activity like this, it begins to make you rethink your positioning in your portfolios. So, I put out a note yesterday. We had a portfolio meeting, which we do every Tuesday. It went on for quite a period of time. We actually delayed it till Wednesday this week, but it went on for quite a period of time, and we went through every single stock in the portfolio. And we highlighted the stocks that are of concern to us right now and what action we're going to take, with respect to those individual stocks. So that's out there. That's with the advisors. If you haven't got it, I know, Kevin, I sent you a copy of it. Please call Kevin or call myself, and I'm happy to, go through that stuff with you and where our concerns are and what our concerns are with respect to that.
Looking backward, what you have been doing in the portfolio over the last few months is you've been adding to the U.S. Can you briefly go through that?
Sure. So, what we've done here is our call as we went through the latter part of last year and looking at commodities and looking at a slower uptick in China, although we did expect an uptick in China, more of it to occur later on in the year, which is really beginning to play out the way we thought, and the U.S. would outperform Canada. So, the problems that we have in Canada, the much debated and really media-hyped pipeline issues, that's been big in the newspapers on an ongoing basis. That, to us, was going to certainly hold back the Canadian energy business, which it has done. The commodity business being held back by a lack of activity in China or slowing activity in China. So we decided that we were going to start to boost up our U.S. holdings. We were allowed to go up to 20% in the portfolios. So in one portfolio, we're about 11% right now. In the other portfolio, Canadian side, we're up about 6-7%. And so that's been a market call that we've made. It's worked out very well for us right now. And it continues to work out well because Canada is correcting more than what the U.S. is. So, when I look at, year-to-date performance, even including this correction, we had a pretty good start to the year in both the equity and the dividend portfolios, outperforming by about 50 basis points over the quarter in both portfolios, which is somewhat unusual because our equity portfolio in a declining market would normally underperform, but it had good enough performance early on in the quarter that slight underperformance didn't hurt us too bad at the end of the quarter, and the diversification into the U.S. So that helped us there. And actually, as we've gone in through this correction, we're actually performing even better because we've had more in the U.S. than what we normally would have. So that does help us out in that, and we'll continue to look at that because we don't believe that Canada is going to pick up here in the near term. We think Canada is more back-end loaded. As you get one refinery capacity coming back on board in the U.S., that's going to be a third quarter type of move. There's a lot of refineries that are being upgraded and changed to take Canadian heavy oil. They typically only take 1 or 2 grades of oil. Well, there's 10 grades of oil out there, and so they've had to redo their refineries in order to take some of the heavy oil. We should get announcements on pipelines. We've had an announcement that they've now gone to open season on TransCanada's proposed pipeline to take oil to the East Coast. So with that, there's obviously a lot of regulatory stuff to go through there, but the pipeline, as far as Montreal, currently exists. So you have to go through the regulatory issues. Can you reverse the pipelines from gas to oil? That type of stuff. Where do you need to add pumping stations for capacity, et cetera, et cetera. So it's still a few years out, but there's relief there. Keystone XL, are we going to get Keystone XL? All of a sudden the political noise is dying down because the economic noise has picked up with the possibility of slowing, economic activity in the U.S. Having said that, though, housing markets are still doing very well. Automobile sales are still hanging in very well. Unemployment's not that bad. It's coming down, and the Fed is pointing to that as, when do they end the quantitative easing, or QE2, which is basically the printing of money. When do they end that? And they're looking at, the unemployment rate as to where they end it. So it's been more on the economic side rather than on the environmental side. And now that we've had a couple of spillages out of old pipeline, the focus is on, should we change old pipeline and put in new pipeline? And there's also been, finally, it's unfortunate, a lot of oil has been shipped by rail. And the environmentalists were ignoring the rail portion of it, which is actually less environmentally friendly than a pipeline. And we've had a couple of trains that have lost a few cars. We've had some spillage there. So I think the focus is now back on, can we get Keystone XL in? And so once you get the pipeline capacity coming on board, the increased refinery capacity, then we see the Canadian economy starting to pick up a bit more, certainly from the energy sector. And, of course, if you get China kicking in later on in the year, then that will help the rest of the commodity sector. So our view is if we're going to release anything here, if we're going to reduce if we're going to change our exposure, it's going to be a continued move from Canada and looking for those U.S. names where we think we can make a significant difference in the portfolios.
Very good. How much impact do you think lower oil prices will have on the economy? I love going to fill up my car and paying less every time I do it.
It's one thing that you come across all the time. There is a fine balance in the energy markets. And I've always been a proponent, and I'm not a conspiracy theorist, but as a lot of guys are in gold, but certainly in oil, I think there's a lot of manipulation in the market. More in the Brent pricing than in the WTI pricing. Because the Middle Eastern countries, in order to avoid social unrest, countries like Saudi Arabia, they don't want to see what happened in Egypt and what happened in Libya and what's going on in Syria right now occurring in their own countries. So they have actually boosted the social parachutes is probably the best way to put it, for individuals in those countries. Therefore, they need that higher oil price. yet they don't want the price of oil too high, because if it's too high, then you crimp overall economic growth. So I think there's a lot of manipulation that goes on in that market to keep Brent crude somewhere around $100, which is going to keep, WTI anywhere between $85 and $90. That's sort of the lower end, and then on the upper end, you get to about $115 in Brent crude, which is going to get you to $95 to $100 in WTI. So that finite balance is always there. I think if you start to go down below $85, in WTI, it tells you that there's an overall economic problem, and therefore that's not helpful either as far as the overall economy goes. So that finite balance. Yes, we all love to have more disposable income to go and spend on other things or put into our bank accounts, but that balance is there, I think. So, we've seen a correction in the oil market from 95 down to 87 and a quarter as it is right now. It was lower yesterday. I think we're in the lower end of that range is the way I would put it. The first part of your answer, you mentioned the magic word. The magic word is gold. What can you tell us there? I think gold right now has just been hit from all sides. It's been a speculative play for many, many individuals. They've put money either into ETFs or into physical gold. It's been their way of, having their bit of savings rather than playing in the market. We go back to 2008 and remind us of 2008. And a lot of people made a significant amount of money in the gold market over the last few years. However, as people are not prepared to pay those higher prices, some people start to take profits. And as you start to take profits in your individual gold holdings, some institutions come out and take profits. Then, stories start to go around. Goldman Sachs put out a story that gold should drop to around $1,400 for the year. SocGen came out, Societe Generale, the French bank, with a very, very good piece, I thought, which, puts it at $1,375 on average for a year. Well, don't forget the first quarter we were up 1,700, so that means to get a 1,375 average for a year, you got to go below 1,375 or below 1,400, as Goldman Sachs would say. So I think the longer-term outlook for gold is still strong. I think the idea behind a lot of people holding gold is deficits at in certain countries. We've seen that in Europe, and we've seen how it's played out in Europe. We know that the U.S. is going through a big debt and deficit problem right now. Will they ever get a handle on it? I don't know. So I think the longer-term outlook is there, but in the short term, we've seen a lot of speculative money come out of that market. That started the ball rolling. Then, the COMEX, it was reported, which is the exchange in New York, it was reported that somebody took out $3 billion worth of gold out of the market there. So took it out of the warehouse. What they did with it, clearly they sold it at some point. So that's added pressures to the market. And then, of course, on top of that, the European Central Bank forcing Cyprus to sell their gold holdings in order to support their economy is another sign. And, I want to put a point on Cyprus here, because we've had a lot of questions over the last couple of weeks about Canadian banks as it relates to Cyprus. And I think they're two very, very different things. And if you ask me the same question with respect to a French bank and a German bank, versus a Cyprus bank, it's a very different thing. I think the Europeans and the core Europeans, such as the French, the Germans, the Dutch, etc., they basically said that they were not going to bail out a tax haven. You're on your own, guys. You created this tax haven where your banking system became 8 times bigger than your GDP. And, if you have to deal with it, that's your problem. Because what essentially occurred was a lot of people went into Cyprus, got paid high deposit rates, much higher than what you'd expect anywhere else, because what the Cyprus banks were then doing were buying Greek debt. And when the Greeks came in, because you would get a nice spread off that, so the Cyprus banks became very wealthy from that. And they were able to pay those higher rates, but then what occurs, Greece defaulted, in essence, right? They took what we call a haircut, or basically went from par value down to about 39 cents in value. Significant haircut, therefore the Cyprus banks lost a fortune and could no longer afford to pay these deposits. Hence, Cyprus banks got into a great deal of difficulty. Could that occur in Canada? I can never say never, but I can assure you that what's going on in the Canadian banking system right now, rules coming out of the federal budget, rules coming out of OSFI, they are making sure that the Canadian banks are still the best in the world, the most secure in the world, and these things they intend to avoid. So yes, there is talk about bail-in. They have to, have rules for bail-in. Bail-in is basically what happened in Cyprus. Is it going to happen in my lifetime? I would put 99.9% security that it's not going to happen in my lifetime, but there's always that 1.1% possibility. So you can never, ever say never, but I think it's a very, very slim possibility.
From this point, you see some volatility in the market. What do you see when the clouds finally clear?
Well, let's go back to the economic numbers that we've seen that have come out, which relate to the month of March. So a little bit backward looking. So we had the Cyprus issue that's caused problems in Europe. A bit of a leak over into North America. I picked up one piece, and I did say in a written piece this week, maybe I'm grasping at straws here. But if you look at the average temperature in the U.S., it was actually the coldest March since 1996. And when you have a period like that, it does weigh on the economy because people do not go out and spend as much as they do. They stay more indoors. People do not build houses in freezing cold weather. So it does have an employment, adjustment, shall we say. We saw a tick up in what we call initial jobless claims because if people aren't employed, they go and claim off Social Security. So we've seen this volatility, and yet the housing markets and the automobile markets, little dip in the automobile markets, but you'd expect that people wouldn't go out and buy an automobile and wander around parking lots, or car lots in the freezing cold weather. So I think that may have had something to do with it. What I'm looking to see now is there a pattern occurring? So as the April numbers start to come out, if I see a pattern occurring, you'll see us move more and more cash. We will start to reduce because there's a good possibility if a trend is beginning to appear here where the economy is slowing down in the U.S. Clearly, the Federal Reserve will not slow down the printing of money if that does occur. However, you've got to look at what's going on in the markets and you've got to say, well, let's adjust our positions and move to cash. I don't think we're going to have to. We may add a little bit of cash in over the next couple of days. But these are just temporary things as far as I'm concerned. I think this is a correction that was much needed in the U.S. Unfortunately, it's leaked over into a bigger correction in Canada simply because of our commodity space and the lack of foreign investment. Canadian investors are in the market. They've been in the market. Institutional investors are in the market. They're now looking for other places, and we need foreign investment to come into Canada. Even if it's temporary, just buying our stock market or buying our bonds, they're not there right now. The U.S. guys are not buying Canada. They don't see, Mr. Carney's out there warning that we're going now from 2% GDP to 1.5%. He warned that in January. He reiterated that yesterday. Now he's gone. He's going off to the UK, to stay in the rain instead of the snow. But when you've got those warning signs coming, it scares foreign investors away. And so I think until we get news on Keystone XL, that pipeline going in, or Northern Gateway, they've actually given Enbridge 199 different things that they have to review before they give them approval for the pipeline. Most of them seem fairly easy from what I understand. The biggest outstanding one is insurance, which, of course, as environmentalists and the native bands, they're going to want what happens if there's leakage. That you've got to pay the insurance. That's a big hurdle to get over, so we'll see. But pipeline capacity, I think, is one thing. Refinery capacity is a second thing. And thirdly, an uptick in China. If those things start to kick in and the U.S. continues on its growth course, whether it's a 2 or a 3% growth course, I think the markets will hang in very, very well. So, a bit cautious, I would say, right now because of what we've seen. So a little bit on the cautious side. But still longer term, I like what I'm seeing out there from an economic standpoint, specifically in the U.S.
As a long-term investor, someone looking out 10 or 20 years, what's the best advice at this particular time?
Oh, stay with the market. Don't ignore the noise. There's too much noise out there. And I do relate it back to, when I look back, I relate it back to 2008, and I look specifically at the banks. And everybody thought the banking system was going to collapse. Now, it virtually did in the U.S. It was a big problem in the U.S. They took massive bailouts. There has been noise about Canadian banks taking bailouts. Canadian banks didn't take bailouts. What Canadian banks were offered, they were offered access to the Federal Reserve window to get money at 0%. Well, as a Canadian bank and as a treasurer, if you're going to get money at 0% today and you can invest it in a bond paying 3 or 4% and take that spread out, you're going to go and borrow money at 0%. So there was a lot of noise around, hey, the banks went to the Fed window and they borrowed money, the Canadian banks. They went for a reason to make money. So we did see a significant decline in the banks. And look where we are right now. We're right back to where we were virtually. So you have to ignore the noise. And don't forget, you've collected nice dividends all the way through. There were no dividend cuts. There have been dividend increases. So you've collected on the way through. That's not the same for every sector. But if you're a long-term investor, ignore the noise and just keep going.
Just a diversified portfolio.
Nice, diversified, balanced portfolio.
Right. Shane, this has been wonderful. Once again, thank you very much for your time today. If you have any questions or concerns, please contact your financial advisor, and they'd be happy to put you in touch with us. Shane, on behalf of all investors in the ScotiaMcLeod group of companies, let's just say, thank you very much for your time today.
Anytime, Kevin.